Let's say you want to start investing in a cryptocurrency like the big bad Bitcoin or the magical Ethereum, or if we're scrubbing the bottom of the barrel, even Dogecoin. So you check the price of whatever coin you're looking at and you see that it's at an all-time high. You expand the graph to see the 1-year trading graph and you see that if you would have invested $1,200, you would have made 20 grand in profit. But like usual, you still don't invest and you figure you might wait for the next low, especially since you've already gotten the dopamine high of thinking how rich you could have been. A few weeks later, you check it and you go, dang, the price is super low right now. Maybe the project isn't going anywhere. Well, a few more weeks of this pass and then decision fatigue kicks in and you don't purchase any of the coin at all. Well, when it comes to the mathematically smartest way to invest in a project that you believe in long term, the solution is simple. You should average out your investment and do something what is called dollar cost averaging. This simply means instead of waiting for the perfect moment to buy a lump sum of crypto, you would put in certain amounts at regular intervals. Welcome to Whiteboard Crypto, the #1 YouTube channel for crypto education, where we spend a lot of time and resources creating these amazing animations so you can sit back, relax, and understand the topic with the help of our analogies, stories, and examples. Let's dig in. What is dollar cost averaging? Dollar cost averaging is a form of investing that has worked well for ages. In fact, we can actually apply it to past data from things like the stock market and see that it mathematically works out really well. Instead of stacking your United States dollar bills in your mattress and trying to time the market for Ethereum to hit a new all-time low, to which you can hopefully time it and then sell at a peak, you invest a little bit over a long period. This way, you are buying in at both the highs and the lows. Just like showing your appreciation for this channel, don't wait for the perfect time. Give us a like right now and ride that dopamine high for the rest of the video. Now, in terms of dollar cost averaging, the time period can be days, weeks, or even months. For example, let's say you wanted to get into Bitcoin. Instead of looking at the price and letting your emotions decide your decision, you instead agree to yourself that you'll put in $100 each month. Now, of course, some months would be higher and some would be lower, but beating your emotions is exactly what the dollar cost averaging method is trying to achieve. You're averaging out your investments so that over time, you are buying into the stock or crypto, but aren't affected by super high points or super low points as much as if you just invested a lump sum. Now, I want to share some anecdotal experiences. About this time last year, myself, my aunt, and my cousin began putting in $20 a month each into a few different cryptocurrencies that we thought were interesting. Now, it didn't matter if the project was going well or if it was going bad. I still put in my $20, and so did the rest of the members of my family. Well, jump forward, and our portfolios are huge, at least when you compare them to the stock market. And it's not because we were some great investor predicting the next big boom, but it's because we stuck to our plan of investing in certain projects that we believed in, and they did well over time. Looking back, we actually bought quite a bit of Ethereum at around $200, which has over 10x'd its price. So now that $20 that I invested is worth over $200 now. Another time that I have dollar cost averaged was a few years ago. I began putting $500 into my Roth IRA as a form of retirement. Being self-employed, I knew that I had to start early, since it's really easy to go every month without committing. Well, $500 a month works perfectly now, as the yearly limit of the contributions is $6,000. But now, my portfolio has grown to more than $30,000 just by investing in a simple index fund. In fact, all of this is done automatically at the first of every month. Looking back, it would have taken a lot of willpower to simply save that much, and quite a bit of that is actually profit from price appreciation and dividend returns. Moving on, according to an article on Forbes, investing lump sums during any dip has been proven to maximize your investment if the investment is up. However, dollar cost averaging has been proven to avoid major losses. Now, another big benefit of dollar cost averaging is that you can set it up to happen automatically each month. And this is important so that the psychological barrier to investing is basically non-existent each month. In fact, if we compare two graphs that use the two strategies of either buying the dip or dollar cost averaging, buying the dip wins, but it doesn't win by much. For us, we do not think that this improvement is worth watching the price every day to see if there's a dip. If we're being technical about it, you could probably spend this time working on a hobby that you enjoy, or even spending extra hours at your job to give you more money to invest. Either way, the smartest way to invest is to have a plan. Many investors rely on their emotions at the time that they either buy or sell, but in reality, the best investors have plans. Maybe something like I'm going to buy any dip that's more than 20% with the $10,000 that I've saved up. Or something like, I'm going to spend $20 a month on this coin no matter what the price is. Both of these methods have been effective for a ton of investors. Alright, moving on, we need a drum roll. Now is the million-dollar question. How do you get started? Well, it's as simple as figuring out how much you can allow yourself to invest in whatever you want to invest in. For me and my family, $20 was easy each month because it was just extra cash. Something else I would recommend is also to start a spreadsheet to track what you have invested. In fact, we will actually leave a download link in the pinned comments of this video for a template that we have created so you can get started easily. It's not anything too complex, but it should get you started on the right track. Now, once you actually start investing, it's time to commit. This is the hardest part. If you haven't watched our video on diamond hands versus paper hands, this would be a great time to watch that video because you'll be tempted with a lot of different emotions once you start gaining money in your accounts. I also want to say many large central exchanges actually have programs that allow you to dollar cost average. For example, Coinbase and Binance both have options to do something like invest weekly so that they will spend a certain amount at each time that you've set up. Another thing to think about is the fees paid using these options. For example, Coinbase's fee usually drops off after you spend at least $200. Under that, the fee can actually eat up quite a bit of your investment, so paying monthly versus weekly may save you some money. As an alternative, Coinbase Pro has even lower fees, but that's for another video. So now that we've told you about dollar cost averaging, we need you to take a little bit of action and not be like we were in the past. Whether it's $5 a day, $20 a week, or $1,000 a month, if you believe in a coin and you want to invest, we recommend putting something in and letting it sit. Emotions and investing do not mix. As we end this video, we want to ask if you have any suggestions for future videos. And if we do decide to create a video on a topic that you have suggested, we promise we will give you credit in the video. Thank you guys so much for watching this video. We hope that you've enjoyed it. We really hope that you've learned something. And as always, most of all, we hope to see you in the next video.